Hi, I'm Erik Renander. I want to give you an update on the Africa Fund for June. We managed to make a little bit of money. The performance was up 30 basis points, despite some difficult markets in emerging markets and Africa. The Dow Jones Titans Africa Index, which is our benchmark, was down 3.5%, and the South African Index was down 4.5%. When we look at the contributors to performance, the top contributors were the bond fund and the short book. Most of the long positions were down, although we did have a good performance from Naspers, which reported full year numbers where revenues were growing and their investments in emerging market internet businesses are starting to really work out. You're seeing these businesses increase their scale, increase their revenues, and starting to break even. So overall, good numbers from Naspers. The positioning of the portfolio hasn't changed much, although we did add to Tullow Oil. It was an existing position, but we did increase the size. Tullow is quite interesting. This is a London-listed oil company with about 90,000 barrels a day of production. They really got hit in 2015 when the oil price crashed and they had too much debt. But the management's been turning the business around, reducing debt, reducing costs, and focusing on free cash flow to shareholders. At current oil prices, the company is generating around 17% free cash flow, which is highly attractive. In addition, they have two big growth projects, one in Uganda and one in Kenya, which should start producing oil in the next 3 years. So you could have about 30% growth in current oil production. The overall Tullow is yielding about 17% free cash flow yield. If you compare that to some of their peers in London at 7 or 8% free cash flow yield, it's pretty attractive. And we think there could be about 70% upside to Tullow shares. So we increased that position a little bit. Overall, it's hard to avoid the extreme negativity in emerging markets. People are very bearish about emerging markets, bullish on the dollar. But overall, I think this is actually a very good setup for the second half of the year. We've had outflows from emerging markets. A lot of emerging markets are down 25 to 30%. So you have good valuations, depressed currencies, and a lot of negative sentiment. When I look at the long positions in our portfolio, we have an average PE of 10.5 times next year's earnings, and for most stocks, over 30% upside. So I know there's a lot of concern out there about emerging markets, but actually this level of negativity and these depressed valuations are quite good and should set us up well for the second half of the year, which could be quite good. So with that, thank you very much, and I hope things go well.